Hey guys, in this video, I will share with you one powerful chart pattern that you can use to maximize your profit. This chart pattern is not only easy to identify, but it's also highly effective and incredibly profitable. Before we dive in, let me give you a sneak peek of what you'll learn in this video. Decoding the chart pattern. We'll break down the anatomy of this chart pattern, empowering you to spot it in a matter of seconds. Understanding the psychology behind its formation. You will know the psychology behind its formation. Profitable trading strategies. You will explore actionable strategies for trading this chart pattern effectively and maximizing your potential profits. So make sure to watch the video until the end, as mastering this pattern can truly revolutionize your approach to trading in the market. So let's break down the anatomy of this chart pattern. Look at this chart example. The head and shoulders pattern has 5 attributes: uptrend, left shoulder, head, right shoulder, and the neckline. Notice that I placed the neckline last. At first, that may seem like a mistake. However, we need both shoulders and the head of the pattern before we can identify the neckline. Now let's discuss each step in greater detail. Uptrend. The very first part of a head and shoulders pattern is the uptrend. This is the extended move higher that eventually leads to exhaustion. As a general rule, the longer the uptrend lasts, the more substantial the reversal is likely to be. Left shoulder. The market moves down to form a higher low. At this point, things are starting to come together, but we don't quite have enough to draw the neckline. The head. Now that the left shoulder has formed, the market makes a higher high, which forms the head. But despite the bullish rally, buyers are unable to make a substantially higher low. At this point, we have the left shoulder and the head of the structure. The neckline is also beginning to take shape, but we need the right shoulder before we can draw the neckline on our chart. Right shoulder. The right shoulder is where things come together. It's an indication that buyers are tiring and that the market may be gearing up for a reversal. As soon as the right shoulder begins, we have enough to start plotting the neckline. But because the pattern isn't yet complete, it's best to think of it as a rough draft rather than a final version. Neckline. Now that we have a defined head and 2 shoulders, we can draw neckline support. This level will become a key component when we get into how to trade the breakout. Think of the neckline as the line in the sand between buyers and sellers. So what causes a head and shoulders to form? All price action carries with it a message. Some messages are easier to read than others, but they're always present. Concerning the head and shoulders pattern, the message is that buyers are tiring and that you'd best prepare for a potential reversal. Let me show an example. As you can see here, the market is trading up, so here buyers are in control of the market. If you notice this uptrend, you will see that it is a strong uptrend because it is clearly making higher highs and higher lows. So right now everything is okay. But the formation of the first shoulder indicates that buyers failed to break up the resistance level. The formation of the head indicates that buyers failed to drive the market upwards. And the formation of the other shoulder indicates that buyers lost control because the market is no more uptrending. So this is how you can read the head and shoulder pattern formation. Remember, a head and shoulder provides you with a clear message, which is buyers are no more in control and sellers are likely to take control of the market. So you have to prepare yourself for a downtrend, or at least a move downwards. Okay, so how to trade this chart pattern? There are 2 ways of trading the chart pattern. Let's start by the most known one among traders: the head and shoulders breakout. One important thing to keep in mind about the head and shoulders pattern is that it's only confirmed on a break of neckline support. And by break, I mean a close below it. Look at this chart. As you can see, the market has closed below the neckline. This confirms the head and shoulders pattern and also signals a breakout. So to trade this pattern, you need to wait for the breakout of the neckline and then place your entry. A stop loss above the neckline, and the target is the next level. Let me give you another example. As you can see here, the market is trending up, so buyers are in control of the market. The formation of this head and shoulders pattern indicates that buyers are no more in control, and a reversal is likely to happen. The breakout of the neckline confirms the pattern, so you can make an entry at the close of the candle that made the breakout, a stop loss above the neckline, and the target is the next support level. The second entry method is waiting for the pullback that happens after the breakout of the neckline. Look at the same chart. As you can see here, this is a clear head and shoulders pattern. The breakout of the neckline is clear, so you can wait for the pullback to the neckline, which is a support level that becomes resistance, and then make your entry. This trading method is good as it provides you with a high rewards to risk ratio, but you have to be patient because sometimes the pullback does not happen, and you can miss a lot of trades. Let me give you an example. As you can see here, if you wait for the pullback after the breakout, you will miss this trade. So both trading methods are good, but they have advantages and disadvantages. It all depends on you to choose the one that fits you the most. I hope this video has taught you something new. Don't forget to like and subscribe to the channel for more videos. Thank you for watching, and see you soon.